All right, let's jump right in. We are going to talk about one of the most powerful and honestly, one of the most misunderstood parts of the entire tax code. You know, it all started with the Masters Golf Tournament, of all things. But today, it's a strategy that could completely change how you pull money out of your business.
Now, seriously, just pause and think about that for a second. Your S-Corp, your LLC, whatever it is, it writes a check directly to you, personally. The business gets to deduct it, which is great, and you don't pay a single cent of income tax on it. I mean, come on, that sounds way too good to be true, right?
Well, it's not. It's actually written right there, in the law. But, and this is a huge but, as we're about to see, there is a right way to do this and a very, very wrong way. And the wrong way, well, that can lead to a truly disastrous audit. So you got to know the rules. Let's get into the mechanics. Okay, first up, let's really get our heads around the core benefit here. Because this isn't just another deduction, not at all. It's what I like to call a tax-free double dip. And to really understand how it works, you've got to know where it came from. It's a fascinating story.
So here it is, in black and white. This is the official stuff. Internal Revenue Code Section 280A-G. And the key phrases you got to zero in on are 1, less than 15 days, which is why 14 is the magic number, and 2, this part right here, shall not be included in the gross income. You know, that word excluded is so much more powerful than deducted. It's like the income never even existed.
And the history here is what's so wild. I mean, think about it. This whole thing wasn't designed for clever business owners trying to save on taxes. Nope. It was created for regular folks in Augusta, Georgia. You know, they were renting out their homes for just 1 week a year during the Masters Golf Tournament, and it was a total nightmare trying to figure out the taxes. So Congress stepped in and basically said, look, if you're renting for less than 15 days, just don't worry about it. It's a non-event. The thing is, they wrote the law so broadly that it accidentally opened the door for everyone everywhere.
And this is where you really see that double dip in action. It's beautiful. So on one side, you've got your business. It rents your home for a totally legitimate business meeting. Rent is an ordinary and necessary business expense, right? So boom, the business's taxable profit goes down. Then on the other side, there's you, the homeowner. You get the rent check. And because of that rule we just talked about, you just don't report it as income. It's a perfect way to move money from the business's taxable bucket right into your personal tax-free bucket.
But, and you knew there was a but coming, with great power comes great scrutiny from the IRS. Which brings us to our next section, how this whole thing can blow up in your face and become a complete disaster if you get it wrong. We're going to break down a real-life court case that is just a massive, blinking red warning sign for everyone.
So let's meet the taxpayers in what's known as the Sinopoli case. We're talking about 3 doctors who owned a Planet Fitness franchise. They decided to use the Augusta rule, and they went big. Over just 3 years, their S-Corp paid them almost $290,000 to hold monthly meetings in their own homes. Now, on the surface, that sounds like a perfect use of the rule, right? But their execution, oh man, it was fatally flawed.
Just look at this gap. This right here is the brutal financial reality of getting this wrong. They claimed nearly $290,000 in deductions. The tax court looked at all the evidence and allowed just $16,500. That means they got over 94% of their claim thrown out. It's a total smackdown. So the question is, what went so disastrously wrong?
Well, the court's decision really came down to 3 catastrophic failures. First, their valuation was just nuts. They charged $3 grand a meeting by trying to apply some commercial square foot rate to their entire houses. It's absurd. The IRS came back and said, hey, a local hotel meeting room costs about $500. Second, their documentation was a complete void. I mean, they had nothing. No meeting minutes, no agendas, zilch. And third, because they had zero proof, the court basically called the meetings phantoms. They just didn't believe most of them ever actually happened.
Okay, so how do we make sure we don't end up like the doctors in the Sinopoli case? The answer is you have to build an audit-proof paper trail before the IRS ever comes knocking. This isn't about just hoping for the best. It's about building a rock-solid system. And here are the 4 pillars of that system, your defense. Number 1, a corporate resolution. This means your business formally decides, on paper, to rent the space and explains the business reason why. 2, a real lease agreement, a formal contract. 3, and this is the one that absolutely killed the doctors in that case, contemporaneous meeting minutes. That means detailed notes taken at the time of the meeting, not months later. And finally, number 4, proof of payment. We're talking a real, traceable transaction, like a check or an electronic transfer, not just a journal entry in your books.
And this quote from the analysis of the case, it just says it all. When you're dealing with the IRS, your memory doesn't count. Your word, your testimony, it doesn't count. The only thing that counts is the paper trail you created when the event actually happened. In an audit, your documentation is reality.
All right, let's really zoom in on that first fatal flaw from the Sinopoli case, the price. How do you set a rental rate that's not just good for you, but actually defensible to the IRS? Because one thing is for sure, you can't just pick a number out of thin air because it's what you'd like to get paid.
So here's your playbook. On the defensible side of things, you get real quotes from local hotels for their meeting rooms. You go on sites like Peerspace or Liquidspace and find what similar homes are renting for. Heck, you can even justify a little bump, maybe 10 or 20%, for the privacy and extra amenities a home offers. Now, on the indefensible side, that's doing exactly what the doctors did, just guessing, or trying to apply some crazy commercial real estate rate to your entire house.
And here's the critical part. Don't just do the research, you have to document it. Create what I call a Valuation.ca for each year. It's just a simple PDF file. In it, you put screenshots of 3 to 5 comparable listings you found, you make a quick little spreadsheet that calculates the average rate, and then you write a short memo explaining your logic. I added a 15% premium because of the pool and AV equipment. That way, if you ever get audited, you just hand over this file and the whole conversation about price is over. It's settled.
Okay, now for the final, crucial piece of the puzzle. Because believe it or not, you can do everything else right. I'm talking perfect documentation, a bulletproof valuation, and you can still get a scary letter from the IRS if you mess up this one last step on your tax return.
So here's the trap. Let's say your business pays you $5,000 in rent for the year. Well, it's legally required to issue you a Form 1099 MISC for that. A copy of that 1099 goes straight to the IRS computers. The computer then scans your personal tax return looking for that $5,000 in rental income. But you, doing the right thing, report zero income because of the Augusta rule. The computer sees the 1099 on one hand and zero on the other, flags it as a mismatch, and automatically spits out an audit notice. It's an automated trap. But don't worry, there's a simple, really elegant solution that tax pros use all the time. It's called the in and out method, and you do it on your Schedule E. Here's how it works. Step 1, you report the income from the 1099, just like the computer expects. Step 2, you go down to the expense section and you list an expense for the exact same amount. And for the description, you just write non-taxable income per IRC Section 280A. The result? The net income is zero. The IRS computer is happy because the numbers match and no scary letter gets sent out. Simple. And finally, let's just hammer this home one last time. Never, ever forget the magic number. It's 14. 14 days. This isn't a rule where you get a little bit of a tax break. It's what's called a cliff rule. If you rent for 14 days, all that income is 100% tax-free. But the moment you hit day 15, bam, every single dollar you collected for the entire year, from day 1, becomes taxable. There is absolutely no room for error here. So the big takeaway here is this. The Augusta rule isn't some shady back alley loophole. It's a real congressionally approved strategy that's written right into the law. But as the Sinopoli case proves beyond a shadow of a doubt, the IRS treats it as a privilege and they demand meticulous proof. So now you've got the playbook. You know how to set a fair price, how to build that 4-pillar documentation shield, and you even know the secret to filing your return correctly. The only question left is, how are you going to use it?